Hello, everyone. Welcome to video 6 of chapter 7 in our discussion on property income. We've discussed interest and rental income. A very high priority topic in this chapter is dividend income. You will definitely see dividend income questions show up on the quiz, the final exam. Um, so because it's a high priority, I want to take this video to explain the concept of integration. The tax treatment of dividends has to do with this idea. And then in the next video, video 7, we will actually do an example of eligible and ineligible dividends or non-eligible dividends. But if you don't understand what eligible means, we'll get there. So let me share my screen so I can go through this explanation of why we do dividends the way we do. So the reason dividends are treated the way they are is because of a concept called integration. Integration is the goal of taxation that a person will have the same financial outcome whether they earn income personally or earn income through their business. So corporations are separate taxable entities, so they pay their own taxes, but those corporations are owned by shareholders, individuals. So corporations will pay dividends, which is after tax monies, to the hand of shareholders where it will be taxed again in their hands. So let's say a corporation made $100. If the corporate tax rate is, say, 27%, that means they're going to pay $27 in taxes. So the $100 they earned minus the $27 in taxes they paid, their after-tax income is $73. So the company made $100, paid taxes. Now the company has $73 left. I, the shareholder, I own the corporation. I want all of the after-tax money to come to me. So the shareholder, let's put shareholder here. The shareholder will receive that $73 as dividend income. Just do this. So dividend income. So because the corporations paid their taxes, the amount of monies available to be paid out as dividends is $73. So now the shareholder receives this $73. Let's say their tax rate, their personal tax rate is 33%. $73 times 33% is another 24. So 73 minus 24 is going to leave them with a final take-home amount of $49. So you'll notice that in this situation, this amount of income is actually being taxed twice. Let's do a gentle highlight there. So by earning it through a corporation, a certain amount of income was taxed at the corporate level, paid out as a dividend, taxed at the personal level. Now, if I didn't have the corporation, if I ran the business individually, my personal income, I earned the same $100 from the business, but now I'm only paying my personal tax rate of 33%, which will be $33. After tax equals the $100 I received minus the taxes paid. My final take home from a personal level is $67. That's a much better outcome than leaving off with 49. So this is an off-balance situation. They want, the Ministry of Finance wants the financial outcome of earning income personally or through a corporation to roughly result in the same position, the same final take home for an individual taxpayer, because right now this income is suffering double taxation. So how do we deal with it? We deal with it like this. If the individual's earning this dividend income, so now we're going to come down to the personal. Let me just insert their shape. Can I insert an arrow? Yes, I can. So now instead of, we're just going to move this 73 over to here. So now they're paying out to a shareholder from a personal standpoint. This individual will have dividend income of $73. What we're going to try to do is return that $73 to its pre-tax amount. So we need to add back this 27. So $27 divided by 73, our final outcome, we need to gross it back up about 37%. So the first step in earning dividend income, we do a gross up. So this number times 73 times that 0.37%, about $27. So the grossed up income becomes $100. $100 and a penny due to rounding, but $100. So we've taken the dividend we received and we returned it to that $100 that was originally received, that same sort of business income. And then we calculate the taxes on it. So tax rate 33%, $100 is still $33. So these are the taxes owing from the individual. This is what the shareholder owes in taxes. So that returns us to that $33. But we can't just pay the $33 because some of the taxes have already been paid by the corporation. So we get a dividend tax credit. So that dividend tax credit is supposed to recognize the taxes already paid. So it's going to equal the 27. So the total amount that I actually owe, let me just put some borders on this since we have a bunch of steps. Total income times 33% is the taxes. And let's do that. And that showing that these two will be subtracted. So my total taxes that I actually owe of my taxes calculated minus my dividend tax credit, the individual owes only the $6 difference. So I came out like this. The shareholder received $73, received the dividend of $73, pays the difference in tax of 6. So they are left with 73 minus the taxes we pay, $67. So this is the outcome from receiving the dividend income from the corporation. I received $73. We go through the calculation to return it to the gross up, calculate the taxes, get a dividend tax credit, and that tells us how much the portion of the taxes owed by the individual. So the shareholder pays 6, the corporation paid 27. Combined, they still paid the full taxes owing of $33. So this $67 of getting it through the corporation matches the $67 final take home for the personal. Hopefully you guys were able to follow that along. We will go through the slides in the next video. I just wanted to give this primer, this preamble, to kind of explain integration more loosely than going through the slides. If left alone, the Tax Act, when the corporation pays taxes, then pays dividends, those shares or that dividend income ends up getting taxed twice. So to combat that, we calculate the taxation as if they'd earned it personally, but you get a tax credit against those taxes for what the corporation already paid. So that is our summary, that function of integration. By integrating our taxes between the corporation and the shareholder, the individual is in the same position whether they earn the income through the corporation and it leaves them with $67, or they earn it in their personal business and are left with $67. So that individual doesn't care how or by what route they earn their income because they have the same final take home regardless. So that is dividend income, the concept of integration. So in the next video, I will go through the slides, we will do the exercise, and hopefully that helps you understand dividends. Like I said, I almost guarantee you will see a dividend income calculation in your quiz and final exam. Thank you for your time. See you in the next video.